What is up, YouTube? Welcome back to Stacks the Numbers, and it's Monday. We got a good start today with markets up a little bit here, about 0.5% across the board. Dow up about 0.1% here, staying green right now. And I wanted to do just a quick overview of a handful of stocks that are reporting earnings today. We got a couple of names here that might have some movement here after hours, so just wanted to give my personal opinion, and we'll see what happens. First company, Palantir Technologies, ticker symbol PLTR, listed here on the New York Stock Exchange. Palantir recently came down, retested this trend line here that I drew out. This is basically our support trend line coming out of last quarter's earnings here, early February. We could see company coming off another nice beat on the top and bottom line. My only concern is, well, first of all, right now, stock's $24.78. It's up about 1.5%, 6% here going into these earnings. Everyone kind of has the gist that Palantir is probably going to report pretty strong numbers here this quarter. I know there's a lot of turmoil happening overseas and whatnot, so this company's kind of positioned in a decent sector right now to actually benefit off of a lot of things that are going on. And we also saw that technology companies, for the most part, seem to be reporting pretty strong. And I know Palantir also has a little bit of cash on hand, even though it has been dropping consistently, but the debt is coming down as well. You have things like the free cash flow now climbing back up, and basically across the board, if you check a lot of the stats, I mean, we could make the argument that the revenue to market cap comparison, in my opinion, is very high. It cannot be denied. And again, I know that this is a trending stock that everyone wants to be a part of, and they are pretty consistent. I cannot deny them. But again, I mean, we're talking about a $55 billion market cap for a stock that brought in about $2 billion last year. Now, putting that to the side, again, the PE up here at over 250, right? So it could be viewed as high. Price to sales here at almost 25, that's the highest it's been. Price to cash flow, 77.25, that's the highest it's been. Price to book up here at almost 15 times book value, that's the highest it's been going back to the last several quarters. Even the enterprise value, supposedly what another company would pay for this stock, is sitting here at 48.7 billion. Market cap right now, 55.25 billion. Now, everything else looks really good in my opinion. The return percentages are up. The gross margin percentage up here at 82. That's the highest it's been. Operating margin at almost 11%, climbing from negative double digits now to positive double digits. Same thing with the EBITDA up here at positive 12%. Net margin consistently climbing up to 15.33% now as of last quarter. So overall, the company is doing well, but my main concern is the fact that it could be viewed as overvalued. However, based on the consistency that we're seeing here, even if we go back here, we can see this was the last time they missed, was back here in August of 23. And you can see the stock dropped and basically immediately rebounded just a couple of weeks after. And then they came back with a nice strong quarter. So as of last quarter, they posted 8 cents a share on 608.33 million, we'll call it. So now moving forward, EPS estimates 7.7 cents. In my opinion, that shouldn't be an issue. This is what I'm concerned about, the 615.4 million, because again, revenue has been consistently increasing quarter over quarter, year over year, very nice growth. But even quarter over quarter, we can see we're slowly stepping higher and higher, right? But we, just in the last few quarters, we went from the low 500 million mark to about 5.5 up to over 600 million. Now estimates coming out at 615.4 million, we'll call it. So, I mean, I can understand if you're pumped about it and you want to give them the benefit of the doubt. So in my opinion, I guess we can lean towards calls. But I will say, if this company reports even slightly light on this revenue number, this stock can easily chunk back down 20% in my opinion and drop back to the low 20s, if not 20 even, and come back to this bottom trend line here of about 20.5. So in my opinion, I'd probably lean towards calls, but if you wanted to, obviously better safe than sorry, maybe consider straddling the situation. HIMS is another company that I mentioned after last earnings report. I said, in my opinion, stock looks good. It's probably going a heck of a lot higher longer term, probably $20, $25 shouldn't be an issue. The stock opened, obviously, from that high single-digit mark up to the low teens and then ran all the way to 17 16 and hit a new 52-week high and has since been stepping down. And if we look at estimates here, EPS estimates at 1 cent on revenue of a touch over 270 million. Market cap $2.5 billion right now. EPS kind of mixed over the last 4 quarters, but we do seem to be kind of on the up and up overall. And we can see quarterly the stock, the revenue is growing nicely. And we just went a couple of quarters ago from slightly sub 200 million, getting above it, getting up to 2.25, getting up to almost 250 million. Now this quarter, 270.3 million. So of course, anything can happen. However, in my opinion, I would probably lean towards HIMS calls, in my opinion. I would personally lean towards HIMS calls. Symbotic, we looked at, I don't remember when, but we have looked at this stock before. It's kind of been staying in this downward channel. Estimates coming out here, revenue 411 million. Little over 4 billion market cap right now. EPS seems to be solid. We have 4 beats in a row. Quarterly as well, the revenue took a slight dip here as of last quarter. Was up to 391. Now estimates are 411. This time last year, 266. So kind of looks like we're in kind of like a little symmetrical triangle here, which means we could break either higher or lower. Right near the apex for the most part here with these earnings coming out. No recent news really maintained that outperform. They have been growing nicely though. You really can't deny them that. But out of curiosity, let me check. For 23, 1.18 billion. Yeah, I guess in my opinion, I'd give them the benefit of the doubt also. I'd probably consider calls on Symbotic as well. So we got 3 calls. Next up is Lucid. Lucid finally started to generate some revenue. Seems to be coming in light for the last couple of quarters. EPS estimates of a loss of about 25 cents on revenue of 173.5 million, we'll call it. 6.6 billion market cap still. Okay, these losses, well, the estimates at least, are narrowing and climbing. Company 2 for 2. It just seems so damn flat here. You know, coming off this Q4 of 22, or a little over $250 million in revenue, and then you can see 149 million, 150, back down to 137, back up to 157. So we're not really breaking up and continuing this climb. And even year over year, you can see in 22, 608 million, 23, 595. Now estimates are up here at 173 million. This will be the most revenue. If they bring this in, this will be the most revenue going back all the way to Q4 of 22. The stock has really been in a sell-off basically since the end of 2021. Yeah, unfortunately, in my opinion, I would actually continue with this trend, and I would say Lucid puts, in my opinion. Next company reporting earnings is Realty Income Corporation, ticker symbol O. This is probably the most popular REIT for a lot of investors and traders out there. Everybody loves O. Solid, stable, triple net leases, nice occupancy rating, market cap here at 47.5 billion. Company's paying out a dividend yielding just a touch over 5.5%. PE almost 44. Now, I said in my opinion last quarter that I was personally looking for a pullback. I just thought it was a little overvalued, and I would like to personally, if I was to jump into this situation, I would try to wait for a sub 50 and some level down here in the 40s, like when we have these big sell-offs here back to the 49s and the 48s. Of course, we had this big dip in October down to 46. That, it's all hindsight, but that ideally, this is why when we look at situations that look fundamentally solid and stable, what do we always say? We could utilize the Buffett method, in my opinion, probably one of the best approaches for longer term investing. And that basically is you make a watch list, right? you come up with a list of names, and it could be any type of stocks. It could be REITs like Realty Income. It could be a larger blue chip stock like a Hershey or something, a Philip Morris, or it could be anything. It could be an AMD, a tech stock that you're watching. Long story short, though, what you want to do is you want to make this checklist, this hit list, and then you want to keep an eye on these stocks. And when they have the dips down and the sell-offs, you can position yourself, and you're basically buying a brand name solid stock for a discounted price, which is basically the Buffett method. So in my opinion, I mean, chances are the earnings have been pretty solid for Realty Income. I know they recently got above that 1 billion mark, and last quarter, again, you can see about a 10% miss on the profitability side, but the revenue basically came in line, and they're holding that 1 billion mark. So now estimates look to be jumping up about 10% from 1.0102 billion up to 1.148 billion on EPS estimates of 39 cents a share when they just missed on 33. So believe it or not, I don't think the revenue may be an issue here. I think the EPS might actually be an issue for Realty Income Corporation here. I just want to check some of these stats real quick. And the good thing about this one is, even though I personally think it's a little high here at 55.40, we can see the stock, I mean, the REIT is really only trading 1.25 times book. You can see the enterprise value up there technically at 71. That's obviously significantly higher than where the stock is currently trading, but our return percentages are actually the lowest they've been going back the last several quarters. Not necessarily a big red flag, I'm just mentioning it. Gross margin percentage, though, is technically the highest it's been the last several quarters. Same thing with the operating margin as well. EBITDA dropped a couple of percentage points along with the net margin percentage. Yeah, I mean, in my opinion, this isn't one that really swings too much from quarter to quarter. But again, me personally, I would try to wait for a more advantageous price. But again, chances are, I'd probably give them the benefit of the doubt on the revenue side, but I have a feeling the EPS may come in slightly light. But even last quarter, you can see we were actually pulling back coming into earnings overall, rejecting off of this top trend line. Then you can see earnings came out, and even though the EPS did miss by 10%, you can see we just kind of stepped up and down and just kind of went into this kind of sideways little channel. And now, as of late, we started to rally for the last couple of weeks. The market had a couple of decent days, and now we're climbing here with momentum coming into earnings. So of course, could go either way, but realistically, I don't think we're going to see much movement on something like Realty Income Capital. But again, in my opinion, probably a beat on the revenue side and potentially a miss on the EPS side. But again, not really an options player for the most part, Realty Income. But the last time I looked at it and said that I personally would wait for a sell-off, I know a lot of people got upset. So, listen, I know you guys, you love your O, and I'm sure it's been doing well for you and pays you a healthy dividend, and guess what? That's what it's designed for. So, I hope that they do beat for all you guys. Next company up, Microchip Technology, ticker symbol MCHP, listed here on the NASDAQ. Tech stock, touch over $93 a share, up 1 3/4 point, and about 2% here on the day. Gears up for Q4. Bada bing, bada boom. Let's see what last quarter looked like. Slight miss on the revenue side. Beat on EPS. And then a miss and a miss. And then a miss and a miss. And then a beat and a beat. So now we're looking at 57.4 cents on the EPS side. And 1 1/3 billion on the revenue side. We have a market cap of 50 1/3 billion. Dividend paying, dividend being paid out, yielding about 2%. We're trading about 21 times earnings, which technically could be viewed as cheap for a tech stock. However, we can see the profitability has really taken a hit the last couple of quarters, and now we have the revenue starting to step down as well. So we were up here well above 2 billion, getting above 2.25 billion, holding that level for several quarters, and now we can see last quarter dropping to 177, and now this quarter down to 133. Now, I would say that I would potentially be bearish in this situation. However, this similarly almost reminds me, well, not really, actually. I was going to compare it to Western Digital, which we looked at. Looked like they had some mixed negative numbers, but it's really not the same story. But you can see the stock was holding about that 5 billion level, coming out of the lockdowns, getting up to almost 7 billion for 22, up to almost 8.5 billion. And now we're about to close out 23 with, what's that, 4.5, 6.2, and then we'll close this out. Let's say they meet this number. We're looking at about 7.5 billion. So we're going to have a slight dip in year over year revenue. Obviously, the net margin percentages are going to take a hit. 50 billion, 50 billion. I mean, again, it's not necessarily overvalued, but it is a big drop in revenue. So we could have a situation where even if they meet or beat those estimates, Wall Street may end up chunking them down. But the stock has been on the up and up, and we do know that the tech sector is doing very well and has been reporting pretty strong for the most part. And you can see the dividend was kind of maintained here in the 70-cent range, and then as of late it jumped up to 91 cents and then $1.26. Look at the debt coming down. Was over 10 billion here in 2018, dropping to sub 10, about 9, sub 8, and then down to 6.6 as of last quarter. As of last year in 22. And looking here quarterly, we can see stepping down 6, and now as of last quarter, sub 6 billion at 5.73. The company doesn't have the most cash on hand, but holding about 300 million. Have that positive cash flow, assets outweighing liabilities. Equity's been slowly climbing. We're up to 13 a share now. Operating expenses came down a little bit, but the revenue dropped. Yeah, and if we look here, the company was pretty solid and now has missed on revenue, not by much at all, but has slightly come in below these estimates for the last 3 quarters in a row, with the EPS beating on only one of the last 3 quarters as well. If we switch over annually, though, the company really has been rock solid, which is probably why over time the stock consistently keeps climbing. So, could potentially make the argument that there are some red flags. However, again, the tech sector has been pretty solid. So, in my opinion, I'd probably go with MCHP calls, in my opinion. Vertex Pharmaceuticals has been pretty solid, as we see. A lot of greens here, slight miss on the revenue side there. And then before that, another slight miss on the revenue side. For the most part, we do have more beats than misses. This is VRTX listed here on the NASDAQ. This stock, a little bit more expensive. One's up here a touch over $400 a share. It's up about 2.5 points here today. $104 billion market cap with a PE approaching 30. EPS has been solid for the last 4 quarters. The revenue has been growing very nicely here over the years. Net margin basically maintaining itself up here in the higher range of the 30%. Almost 10 billion, market cap over 100 billion. So these pharmaceutical companies really trade at high multiples. Whether we're looking at Vertex, or we're looking at something like Eli Lilly, all of these stocks really trade like 10, 15, 18 times annual revenue. So, what that tells me is not necessarily that they don't deserve it, but it could really start chunking down at a moment's notice. But Vertex, I will say, does really seem to be maintaining itself here, keeping these numbers, not having many inconsistencies. 252. Now this quarter we're up to 258. 408. Okay. So we only have 2 misses on the revenue side over the last 8 quarters and only 1 miss on the EPS side over the last 8 quarters. So if we switch over annually as well, we can see almost coming in, excuse me, basically at that fiscal year number for 2022, coming in just a touch shy and then coming out and beating by just a little bit. But we can see that revenue forecast to continue to grow here. We're seeing basically about $1 billion jump in revenue year over year. So I can completely appreciate the hype. And even moving forward here, quarter over quarter, we're still expecting more growth, and on the EPS side as well. So even though it is overvalued, I mean, I guess I'd give him the benefit of the doubt for this one. And again, cash is important, and we see this company, the cash has really been climbing nicely here, going from $3 billion up to $7 billion, north of $10 billion. Assets heavily outweighing liabilities in both the long and the short term. I just want to check the debt. The debt was pulling back Q4, $808 million. That time the year before was almost $900 million. So even though the debt did jump back up, it was consistently decreasing, and it's not as high as it was. 10 billion, 11 billion, 10.3 billion. Yeah, in my opinion, I would say VRTX calls, in my opinion. Teradata. Yeah, this company's been popping and dropping. Okay, we were kind of inconsistent. Now we're back on track. 55 a share, 461 million. 62 PE, 3 beats in the last 4 quarters on the EPS side. Yeah, it's really, the profitability is really falling off a cliff though. Now we're back up to 55 cents a share on 461. 461 this time last year, 476. Okay, checking the debt here, kind of maintaining. Cash took a hit in Q3, back up to almost 500 million. Short-term liabilities outweighing assets. Equity took a hit from this time last year. Book value got almost cut in half. In my opinion, I would say Teradata TDC puts, in my opinion. There's a lot of names here, so we got to start to speed this up here. Simon Property Group is one that did very well coming out of the lockdowns, rallying basically about 200%. There's another REIT, pays you a nice healthy dividend to own it, Simon Property Group SPG. This is one that a lot of people actually like this a little bit more than Realty Income. Market cap 46.5 billion, paying out a dividend yielding 5.5% on a PE of 20. Beating on the EPS side the last 2 quarters after slight misses. So the profitability side shouldn't be an issue here. $1.35 on 131 billion. And you can see margins and revenue, everything across the board has really been on the up and up the last couple of quarters here at Simon Property. Last quarter 153, this quarter 131. 131 would technically be a drop in revenue year over year. I don't have the time to break down the entire portfolio for whatever the reason might be right now. $1.35. On 5.6. Yeah, so this one actually isn't as overvalued in my opinion as Realty Income. So if you think it can maintain and be on the up and up, I guess I would agree with that. But again, that's technically a drop year over year, and of course they could come in above those estimates. But I don't know. I don't know if I'd if I'd step into SPG. My personal feeling is real estate has been doing so well, even when you could make the argument that it shouldn't be. So again, if technically something like these quote unquote solid, safe, stable REITs are on the up and up and never go down and have been maintaining their value, in my opinion, if and when, chances are, a market correction and big sell-off does take place, the REITs are probably going to take a hit, because I have a feeling that the real estate market may potentially top out sometime soon. So right now, this is just my opinion. Right now, I would stay away from these REITs. You could make the argument that they're overvalued, but SPG, again, we know these REITs don't really move that much into after earnings. SPG went on a nice run, though, coming out of this November quarter. In my opinion, I would say SPG puts. Goodyear Tire, we got a lot of technicals going on. We go back to the last couple of quarters. Nice beat on EPS. Missing revenue by about 5%. Same thing, missing revenue by about 3%. Missed top and bottom, So it has been very inconsistent, but again, these material stocks have basically been either holding their own or slowly climbing underneath the radar. Because again, at the end of the day, we're going to need what we need, which is why I feel like a lot of money is piling into your Goodyear Tires, your Louisiana Pacifics, LPX, Southern Copper recently has been hitting highs, SECO, but also, again, it's basically the necessities, right? The materials, the food stocks. I've recently been updating people about PPC, Pilgrim's Pride. Chicken demand is on the up and up. PPC opened new 52-week high today, $36.99. That stock originally brought to you on this channel down at like $24, $22 a share. But Goodyear Tire sitting here a touch below 12.5, so up 20 cents, about 1.5% on the day. $3.5 billion market cap. You guys know how I feel about that, but the company is technically losing money per share. The EPS now has really turned around in the last couple of quarters, beating the last 2 quarters in a row. Quarterly side, we seem to be kind of bouncing around this 5 billion mark. Now estimates drop back down to 478 for Q1. This time last year, 494. Expecting a loss as well of 1.3 cents. Let's check some of the numbers. Book value is about 30% higher than where the stock is currently trading, even though this technically is the lowest it's been going back the last several quarters. You can see the operating income was on its way down to flatness, potentially negative, and has chunked up here in the last couple of quarters. Let's see. Yes, we're no longer paying our dividend. That stopped a couple of years ago. We have assets outweighing liabilities. The debt has been on the up and up. Let's check quarterly, getting up to 10 billion, down to sub 10, 9.6, 8.6, with about a touch below $1 billion cash on hand. Could be, you know, it's inconsistent with something like Goodyear Tire, which in my opinion seems like the stock has never really taken off. However, over the longer term, I do still see growth. Again, this is a company that's bringing in roughly $5 billion a quarter with a market cap of $3.5 billion. So this could be an interesting situation to play out for the longer term. And again, you can see something like the price to book. It's only trading 3/4 of its current book value. 3 times cash flow. Look at this. Less than 0.2 times sales. The enterprise value is 3 times higher than the current market cap of the stock. And again, I understand a lot of these margins have, a lot of these return percentages have come down. Look at the gross margin percentage though. Was up at about 20%, drops all the way down to the low 15s, and now as in the last couple of quarters, completely rebounded to almost 20%. Same thing with the operating margin as well. Was heading down, almost got flat. Now we're back up to 5-6%. EBITDA back up to almost 10%. The net margin took a hit recently. Inventory turnover up a little bit. Asset turnover back to 9.1. Debt ratios basically look in line. But yeah, it has been pretty inconsistent over the last several quarters. Now we're back down to 478. This time last year, 494. Before that, 491. And we're expecting a loss of 1 cent. Believe it or not, I would give him the benefit of the doubt, because I do feel that the stock is undervalued, in my opinion. And even last quarter, we can see the revenue missed by almost 5%, and we chunked them down here early February. And then, 4, 5, 6 weeks later, all of a sudden, we're actually back up and above where we were when we reported earnings. So, in my opinion, I still say, me personally, I like Goodyear Tire, and I would probably be a buyer here. I would consider GT calls going into earnings. I think there was 1 or 2 more. Vimeo. Vimeo was one we looked at. I believe I said I liked it. Stock exploded last quarter, going from 3 3/4 up to about 5 3/4. Completely pulled back down to about the 3.5 mark, and now we've been slowly climbing. Looks like trying to get back to that 20-day moving average. We're expecting almost break even, a slight loss on about 100.4 million. $638 million market cap on a 28 PE. Tech stock, Vimeo. In my opinion, I do think it's undervalued still in the longer term. And I don't remember exactly where we looked at it, but as you see, the stock had an explosion. I'm pretty sure it was in here in this channel where I was saying I like it, down here in the 370s, could be worth buying. And then I guess it exploded to 570. Honestly, I didn't keep an eye on it. Honestly, I'm not trying to make it seem like I'm better than I am. I'm just going name by name here. It turned out to be right with this one, it looks like. But the revenue has been slowly stepping down, and now we're at 100 million. Actually, not really stepping down, just kind of flat for the most part. Now we're at 100 million. This time last year, 103.5 million. Net margin percentage came up to almost 8%. Profitability seems to be climbing with revenue. Closed out 23, 417 million. Market cap 638 million. Let's check what's going on here real quick. How's our debt looking? Down to 13. Okay, debt seems to be consistently dropping. Cash consistently increasing now as of last quarter. Got above that 300 million mark. Assets outweighing liabilities. Okay, we're on the up and up. Book value keeps climbing. In my opinion, I would say VMEO. I would say Vimeo calls, in my opinion. And I just want to see, is there anyone else really? Another REIT, Vornado, VNO, JELD. Is this another lumber wood product? Yep. What is this? ML seeks court reversal of order to shed one the door skin plant. Recently, I know Weyerhaeuser, a lumber company, I know reported earnings, and I said, in my opinion, it's probably going to be light because all of the building and upgrading for houses and real estate was probably done already, and everyone's waiting and looking to flip these situations. So I projected, in my opinion, that revenue would be light, and it turned out to be light for Weyerhaeuser, ticker symbol WY. So we may have a similar situation here with JELD. 1.68 billion market cap, PE 23. EPS has been very solid for this company, I will say. They've been coming in well above estimates here for the last 4 quarters in a row. Annually got up to almost 5 billion, slowly stepping down. Similar situation like we saw with Weyerhaeuser. You can see net margin sitting at about 1%. And quarterly, yeah, look at the way, see, we're dropping now after coming off of those highs. 1.02, and now we're down to sub 1 billion now at 965.92 for 23. I mean, we could also make the argument that it's very undervalued in the numbers. However, again, because of the sector they're in, and again, this is just my opinion, that I feel like a lot of this revenue flowing into some of these like home building, home renovation companies, I think that revenue has lightened up, which is probably why the estimates are down there now at sub 1 billion. So in my opinion, I would probably say puts on JELD. I'm going down the list. I think that's pretty much it for a lot of names that most people would play. Obviously, there's a heck of a lot more companies reporting earnings, but I just wanted to go over a handful of companies. Oh, and we have Coke. You guys remember Coke? I believe was brought to you on this channel back at like, I don't know, yeah, like sub 550 or something, I think, back here, early 23. And obviously the stock went on an absolute run, hitting almost 1,000. New highs of almost 962. We've been kind of in this consolidating zone, and now you can see today that the stock is now above this top trend line on anticipation of these earnings. And kind of looks like a big long-term bull flag almost. So the stock may be ready to take the next leg higher, but earnings coming out today after market close. $8 billion market cap, PE of 20. For a quote-unquote defensive stock like this, again, this is a Coca-Cola bottling facility, Coca-Cola Consolidated, COKE, not to be confused with Coca-Cola, parent company, ticker symbol KO. This is the bottling facility. Again, their only responsibility is to bottle these drinks and ship them. That is their job, and as you see, it has been consistent, and it has been on the up and up, closing out 23 with $665 billion in yearly revenue with a market cap of $8 billion, which is why, again, this may not be a stock that'll go from $850 to $2,500 in a month or two, okay? That's probably not going to happen. However, if you give it time, again, Wall Street will most likely, and investors alike, will most likely see that it could be viewed as undervalued in the long run, so they'll continue to add to the position on the dips. And like we always say, in my opinion anyway, slow and steady wins the race. But we can see profitability has been taking a hit. 174 down to 163 now. Net margin percentage slightly down to sub 5%. Overall, in my opinion, I just think it's too much of a solid, consistent company. Annually, we're just on the up and up. Look at the profitability really started to take off here in the last couple of years. Now it looks like it's kind of starting to come back down here throughout 2024, but the company recently chunked up the dividend there. Look at the debt was up here above 1 billion. Now we've been chunking down. We're here in the low 700 millions. 736, 735. Technically, the debt has been dropping. Yes, the free cash flow has taken a hit. However, the cash on hand has been consistently climbing as well. Look at this now on the up and up here for the last 5 quarters in a row at least. Assets outweighing liabilities, over 600 million cash on hand. Again, solid, stable grower. Pays a dividend to own it. And again, I know it's much more expensive. So I know not everyone watching could potentially invest into a situation like this at $859 a share. But again, these are the types of companies that we like to look at and we like to bring to the table. But yeah, I've spoken for way too long. But Coke overall, in my opinion, not really an options play. But for the record, I personally still like it for the long term. And we have numbers coming out today. So I just wanted to give a quick update on Coke, but that's pretty much it. Now I'm going to end it there. So I'm sorry for going on for so long, but I did want to give each name, at least a couple of minutes, give them a fair shot. But yeah, overall, those are my views, and anyone taking a position today, of course, we know that earnings are 100% a gamble. Please understand the risks involved, but I do wish each and every one of you the absolute best of luck, and I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel, and of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, they're very uncertain. I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. You guys have a good day.